Hi, welcome back to the personal finance course. This is the section or segment 3 of 3 in the chapter about mutual funds. Great to have you back. We're going to talk now about how to evaluate mutual funds. How do you choose them? So we've learned about what they are, and we've learned about target date funds and large cap and small cap and value and all these different kinds of funds. Well, how do you choose them? Well, there are companies that specialize in this, like Morningstar. Mutual fund companies, notice on the right here of the slide, Vanguard. This is a screen shot of a Vanguard evaluation of one of their portfolios, the total stock market index fund. And it has information about how much cash they have, percentages of US stocks. Notice in the lower right of this evaluation is simulation of the Morningstar introduced style box chart. In the top it's large cap, in the bottom small cap, to the left is value, to the right is growth. We introduced this in the chapter on investing fundamentals, but Morningstar was who introduced this initially. But it's become an industry standard. It's like your cell phone, right? On your cell phone, green means make a call, red means stop the call. It didn't always used to be that way, but now it's a standard. And this style box approach to defining the characteristics of a fund or a stock has become the standard. Investment companies provide this information for their clients too. A prospectus. All mutual funds, when they're introduced, have to have a prospectus. They have to be produced on a regular basis and certainly provided to new investors. And they include things like who the fund management is, who the ownership is, what the past performance has been. You know that you've seen all the disclaimers, right? Past performance is no indication of what the future will be. Doesn't say that exactly, but it's something to that effect. But the past is all we have to look at. If you look at an employee you're thinking of hiring, right? And you look at their resume and you meet them and you think, all you know about what they'll do in the future is how they've behaved in the past. And with a fund, certainly a mutual fund, certainly what they've done in the past is not definitely going to be what they do in the future. Might be, but we don't know that for sure, right? Well, it's all we have to look at. And so we look at the past to see what the future might be. In addition, in the prospectus, what securities the fund is permitted to purchase. When I worked in the mutual fund industry, in the investment management industry, at this part of the prospectus, our fund managers wanted as much latitude as possible. They want to have as few constraints as possible. They want breadth. They want to be able to do as much as they would like to produce returns, do better for themselves, and do better for their investing clients at the same time. It describes distributions, dividends, tax treatment, how to open an account where you can buy and sell, fund company services, contact information. All that is in the prospectus. And then news platforms like the Wall Street Journal, the New York Times, Forbes, and Fortune. Used to be there were magazines too that used to do this, some of which no longer exist. This information is available everywhere. There's podcasts and blogs, and it's on your cell phone information about mutual funds. So that's where you get the information to make your evaluations about mutual funds. Now this is important too. How do we measure performance? What do we look at? Well, certainly the historical returns, the 1, the 3, the 5, the 10-year, the since inception returns. Remember that returns are, it's like an accounting regulation, and so they're produced and accounted for in specific ways so that you can make apples to apples comparison. This is done by the regulators. Again, the past doesn't tell us for sure what the future will be. The future is going to be different. But the past is, in many respects, the only way we can judge what the future might look like. If the management is the same, if the securities that the fund can invest in is the same, if the strategies are the same, the future should look something like what the past looked like. Again, the future is not definite based on the past, but it's all we have to look at, the past is, to determine what the future might be. The standard deviation. Now, this is a challenging one. I took this chart, this graphic out, put it back, took it out, put it back, had a few others, and I settled on this one. Notice that the mean is in the middle of this standard distribution. Standard meaning that it's a smooth curve. And then there's sections for 1 standard deviation and 2 standard deviations. Standard deviation is a measure of how much of an occurrence occurs, how far it occurs away from the mean. Here's a chart that I've prepared that I use often when I talk to students. The X's are when people show up for class. Assume class time starts at 6. Here's 6:05, 6:10, 6:15. Here's early, 5:55, 5:50, and really early, 5:45. If I were standing at the door, or someone was, and making an X when everyone arrived, I would notice that most arrived at right around 6. This is just an example. Maybe in real life they arrive a little bit before. But anyway, some arrive early, some arrive late. And if I draw a smooth curve through these arrival occurrences, this is called a histogram, by the way, draw a smooth curve, I know that I can calculate 68% of the time is 1 standard deviation. That's about 2/3. And so we can estimate that about 20 students show up between 6:05 and 5:55. This is an estimate now. This is just for example purposes. There are ways to actually calculate this. But what that means is that 1 standard deviation in this example is 5 minutes. 1 standard deviation plus means 6:05. 1 standard deviation minus means 5:55. 95% of students, this is 2 standard deviations, represents about 29 students. This, by the way, is in a class assuming 30. Just made it easy. So the point is that 95% of the students arrive between, and 2 standard deviations is 10 minutes. 2 standard deviations less than the mean is the median, rather, the median. 2 standard deviations less is 5:50, and 2 standard deviations plus is 6:10. And this is exactly the way stocks work. We know what the mean return is. Let's say it's 10%. If 1 standard deviation is 5%, we know that 68% of the time, about 2/3, roughly, about 2/3 of the time, the stock is going to be produce a return in a year of 15% or 5%. I did 10% being the mean, 10% plus 5, 10% minus 5. The Sharpe ratio is a risk-adjusted return. Others that are useful are the Trainer and the Sortino ratios. But the Sharpe ratio compares the return of a portfolio to the risk-free return. It takes the difference between those two and divides by the standard deviation. For this, Bill Sharpe won a Nobel Prize. Nobel Prize. It's a great, elegant comparison of a return over an unmanaged portfolio, the risk-free rate of return. Might be 3-month T-bills or something like that, or even a money market return you could look at as a proxy for it, divided by standard deviation. It shows a risk-adjusted return relative to volatility. And then maximum drawdown. In any one year, stocks, for example, might be down 20%, 30%. This is any one day, for example. And so that volatility is not always easy for everyone. If you want to stop a security that won't go down that much, you have to change your investment so that it won't go down. Now, over time, it may go up, even though it's down 40% at one point, it may be up 40% at one point during the year. And over time, it may grow to a greater amount than the security that won't go down 40%. It only goes down 5% at any one time in a year. You have to have time frame to your benefit then to be able to tolerate that kind of volatility. So how do we choose a fund? Determine your time frame, short, medium, or long. Long gives you the opportunity to tolerate volatility. Short, I'm getting married soon, I'm going to grad school soon. Short means I can't tolerate a lot of volatility. I've got to have low expectations for maximum drawdown. Review again in the investment fundamentals chapter, the slide called investing plan, and in the stocks chapter, the slide called, okay, so how should I invest? Review those two. We talk about having a bias for equities, knowing your time frames, keeping your costs down, review regularly, rebalance from time to time. In addition, consider the measures on the previous slide, historical returns, volatility, the returns relative to volatility as measured by, for example, the Sharpe ratio, and the maximum drawdown. How much could it be down at any one time in any year? And look at cost, the expense ratio and the loads. For all things being equal, for the average investor, lower costs are better. Do some funds with higher costs such that the net return is greater than others? Does that happen? Sure. It doesn't happen often over the last, say, 10 or 20 years. In the majority, lower costs do better on a net return basis. But can you find active managers that beat it? Yes. And if you can find them and they're consistent and they're exceptional, try them. And make sure to consider diversifying funds by asset class. Yes, diversify an already diversified portfolio because your asset classes need diversification. In your 401k plan, for example, you might choose large cap and small cap, or stocks and bonds, even though both of those funds are themselves diversified, right? But they're investing in one asset class and they're going to have behaviors that mimic the asset class. So make sure to diversify even using funds in your portfolios. Where can you buy and sell funds? In person, with an advisor. It's going to be more expensive most likely. With a fund company representative, in person again, likely to be more expensive. On the phone or online, those can be direct so that you have an opportunity for no load, low load, or free funds if you do these direct. And you could also you might pay an investment management fee with an investment advisor, but maybe no load. Advisors break into commissions, hourly fee-based, project fee-based, and I just mentioned investment advisors that charge on a assets under management basis. So you can buy and sell at a variety of places, and you can obtain them through your company-offered 401k plan, direct with fund companies on their websites. Administration will help you open an account, fill out an application. This is administration of mutual funds. Purchasing and selling, you can do it by hard copy application, on the phone or online. You may have to prepare in advance, but you would submit it online. Account minimums are generally between $500 and $3,000, but can be as low as $100, as I mentioned earlier in this chapter. And fund company or fund families have benefits, such as offering a variety of asset classes and strategies, similar approaches to management, meaning the way they manage, are they aggressive, are they conservative, as examples, permitting switching from one fund to another without fees you can do within one family or one company, and having automatic withdrawal and investment, meaning you can sign up to have the fund company take money directly out of your account. It's a great way to save. I mentioned this earlier in the chapter. Great way. You won't even miss the money coming out as long as it's an amount that's reasonable relative to your earnings every month. This direct investment approach. These are services that fund companies can provide for you. The largest mutual fund companies, Vanguard Group, $3.4 trillion. This is as of July of 2017. The largest asset managers are BlackRock, but that would include institutional management, pension funds, hedge funds, and those kinds of things. These are just mutual fund companies. Vanguard Group, $3.4 trillion. Fidelity, $1.9 trillion. American Funds, $1.6 trillion. T. Rowe Price and BlackRock, you can see, at $495 billion. So this has been the mutual funds chapter. Thanks for joining me for it. I'm Tom Mihawk. You can find me at tommihawk.com. All these slides and video presentations will be at my YouTube channel, so you can find them there too. Thanks for joining me.